Okay, what's up, y'all? So today we're gonna go over Elliott Waves, pretty much the 2.0, and I'm gonna be pretty much giving y'all kind of an intro into how you can start finding these patterns. So we'll kind of start off a little basic with just reading the market, and then I'll show y'all how it kind of correlates into Elliott Waves, right? So we'll kind of dive into that kind of both and merging in at the same time. So there are a few rules that you guys do want to keep in mind when it comes to Elliott Waves. And so we'll pretty much start with going over some of those rules. Some of them kind of vary, but just the general rule of thumb, right? So when we're speaking of Elliott Waves, this course is going to be basically off of how I trade Elliott Waves, right? So the way that I use them. So I'm not going to be going over all of the different waves as far as, so you'll have your A through E, you'll have your WXYs, and such. I mainly focus on the 1, 2, 3, 4, 5 and ABC. So I'm going to be showing you guys how I use those personally. Cool. So when we're speaking of a 1, 2, 3, 4, 5, right? So there are 3 impulsive waves, and then there are 2 corrective waves, right? So your corrective wave is going to be here, which is going to be from this 2 point. So this is technically 2. So this is wave 1. This would be considered 2, right? So 2 is going to be corrective, right? This is wave 3. So 3 is going to be impulsive. 1, 3, and 5 are impulsive. Wave 4, which is here, is going to be corrective. So 2 and 4 are corrective, right? So this right here is going to be 4. This, again, is 2. They are corrective. 5 is going to be impulsive, right? So you have 3 impulsive waves, 2 corrective waves, right? So now that we broke that down, wave 3, so getting back to the rules, wave 3 is typically not the shortest out of the 3 impulsive waves. So if I were to make this as far as a real example, you can have 3 equal to the others, but generally it's just, remember that generally it's not the shortest of them all. So 1 and 3 can be the same length, and let's say 5 is around this length, right? So you can see that pretty much wave 3 is the longest out of all of them, so that's fine. If you have 1 kind of this long, and then you have 5 this long to where now 3 is the shortest, then it's a little bit more questionable. But at the same time, and it's not questionable that there's no waves here, it's just questionable that you might have them illustrated incorrect, and maybe this is not the actual 3, maybe 3 is somewhere else, right? But at the same time, this is an example to where 3 is potentially not the longest, but the shortest. So 3 should not be the shortest among all 3 of the impulsive waves. So just keep that in mind as you are trading them. And then you have wave 2 and 4 are going to be corrective. Generally, in your corrective phases, you're going to get an ABC pattern, or you're going to get another inner 1, 2, 3, 4, 5. So we'll go over how that looks, but just want to give you guys the rules starting off. So wave 3 is typically not the shortest among all 3 waves, right? And then wave 4 should not overlap wave 1. So if we are to clear this, cool. So this is wave 4, right? So general wave 4 should not overlap wave 1. Now I have seen it to where, you can get your reversal pattern like that, tapping into 1, but you don't want it to just disrespect 1. Like let's say this is 50% of that retracement into 2, right? So you don't really want it going around 50% up. You really kind of want it to maybe stay around that 25% at max. So just a little bit digging into 1, still respecting 1, because you got to think if you fluctuate to maybe a higher time frame, those closures of those candles might not be all the way up here. They might be down here, and this might be wicks on a higher time frame. You know what I'm saying? So a double top, let's say this is a double top on a higher time frame, it could have actually closed below 1, but it could have just wicked above 1. You see what I'm saying? So fluctuate through the time frames. Make sure you're seeing what you need to see in price action, but just a little bit is okay, right? But you just don't want it starting to break high into 1. Again, it would go similar to how we were illustrating on wave 3 potentially being the shortest. It doesn't mean that there's no waves in the whole. There's always going to be waves, Doesn't mean that there's no waves in the actual whole analysis that you're looking at. It just potentially means that maybe that wave area that you picked might not actually be 2. So 2 might be showing somewhere else. So your wave count might be off. So that's what it's potentially showing you. So you might want to recount your waves to make sure. So second rule to remember is that wave 4 generally would not overlap wave 1. Cool. Last rule of thumb is that wave 2 should not break below wave 1. Cool. So this is wave 2. This is wave 1, right? So this whole wave is wave 1. You don't want to breaking all the way up here. Then it changes everything. So it's almost not the start of a 1, 2, 3, 4, 5. It changes everything. So 2 should not break wave 1. So just be mindful of that, which most of you guys would more than likely know that, because then it would kind of change how you would even look at the waves. So those are pretty much your general rule of thumb, y'all, that you want to keep in mind when you are trading Elliott Wave. So just the main 3 rules right there. Anything else is just kind of a little bit extra, but those are the main 3. Okay, so now that we know the rules and how we look at Elliott Waves, we'll start off with just getting a general picture of how you can find these. Now, there are indicators that help you, which I'll be giving you guys an indicator once we start going a little bit deeper into Elliott Wave that y'all can use, that I have used for maybe about 2 years. I've been trading Elliott Waves. No, I've been using the indicator, for about maybe 5 months. I've been trading Elliott Waves for about 2 years. So the indicators is pretty spot on. I don't go specifically off of the indicator. I actually use it as a checker. So generally I can see the Elliott Waves just naturally. So I usually add the indicator on to kind of check to see potential areas. So how I was saying, like, if you're marking the Elliott Waves right, and you potentially have a wave that's not looking completely right towards following all the rules, and you might have your waves off, right? So if there's an example to where you have your waves off, if I'm charting and I feel like my wave's off, that's when I add the indicator on there so I can see what it sees. And so if it confirms that my wave is the same, then I rock with it. But if I do see, like, let's say I'm like, okay, maybe this is the wave, right? And then I put on the indicator and then it's showing me that it's seeing the wave on the other option, like I was seeing for a potential secondary option, I might want to go with the secondary. See what I'm saying? So that's kind of how that works. So I'll show y'all how I use it and everything, and how it works and how you can find it and use it yourself. Cool. So let's go ahead and dive on into basic price action. You have to understand price action in order for you to understand Elliott Waves. So you have to be able to read the waves, read price. So we're just going to go through a general breakdown of price action, right? So you have an impulsive market, right? And you have an impulsive market. One is going towards the upside, one is going towards the downside, right? You have a corrective market, okay? And actually we would more so consider this consolidation, I'm sorry. So consolidation, you can throw corrective and consolidation kind of in the same category. It's just how you trade. But we'll throw this as, we'll treat our corrections a little bit different on this tutorial, and we'll give actual corrections, okay? So you have a corrective market, whether it's bullish or bearish. So, and we're going to go through all of these examples as we break down price action. So I'm going to show y'all how to read the market piece by piece, okay? So you have that bullish correction, okay? And then you have reversal patterns, right? So this is your general movement of your market right here. And then you have your reversal pattern. So at every peak in the market, whether it's at a top or a bottom, you're going to get a reversal pattern. So it's up to you to find the reversal pattern. You do have to fluctuate through time frames. That is a requirement. It's just because you're not always going to be able to see it on the time frame that you're on. So sometimes you have to go a little bit lower, go a little bit higher to see it a little bit more clear. So, but always, there's always going to be a reversal pattern. So just always remember that. Your general reversal patterns are going to be your double tops. And this is going to be real basic for a lot of y'all. Okay. So you have your double tops and you have your double bottoms, right? I'm going to show you how all this relates when we go through the market. And then you have your head and shoulders patterns. And for those of y'all that don't know or not familiar with all of the reversal patterns, Google forex reversal patterns. you'll see a list of all of the different patterns that you can expect to happen when the market is potentially reversing, right? And then you have your rising wedges and then your falling wedges. So these are, you have reversal patterns, you have continuation patterns, two different things, right? Let me see. So this is going to be a reversal. And then if it's going to be and so how you would see it in real market time is you would see something like this, right? And then you would see the market break towards the downside. So if it's going to be in the opposite direction, you'll see something like this. So the key to this is all about the angle. So this here, how it's angled, this is what matters the most about this reversal pattern. This is what makes it the difference between a continuation and a reversal pattern. So you might get confused between the similarities of the wedges and the flags, because let's say if it's a bullish flag, your correction is going to go towards the downside, right? So you see how this one corrects towards the upside? That's going to give you your signal that the market is wanting to reverse. This is a reversal pattern. This is a continuation pattern. So that's the difference between the two. So if you are looking at a bearish scenario, this is going to be a bearish flag, which is a continuation pattern. So if this was angled like this, right, that would be the signal for your potential reversal pattern. So it's all about how it's angled right here. Cool. So these are the general reversal patterns that I use in the market. These are the general patterns that I just look for straight off top, right? So I don't really like head and shoulders as much. I mainly like double tops, double bottoms. They just mainly go for me. So we're going to be using all of this as we go through and now break down these charts in every way, every movement. So as we break this down, I don't want y'all to be focusing on the inner waves as we go through this. I'm only going to be picking kind of the bigger picture as we go through everything, okay? So just kind of follow through with me and just kind of try to catch on as you can. This is a very good thing to do as far as in your free time to help you understand how the market moves and to learn how to see everything. So how you need to see it. Structure, this is going to help you learn how to see structure. It's going to break down a lot for y'all and give you clarity on how to see and read the market, okay? So, for example, again, every top, every bottom, every peak is going to have some type of reversal pattern. So we'll start here, right? So here, the first pattern we can see is a double top, right? This would generally signal the movement towards the downside, right? So at that double top, we then have impulsive wave, right? So again, we're using everything that I showed y'all over here. I'll make another smaller image so you guys can kind of keep an example of all of the things we will probably be using as we go through this. And we have our consolidated market, and then we have shoulders patterns, and we have wedges. So I'm mainly going to be focusing on reversal patterns right now. And again, you have those continuation patterns. Google forex reversal patterns, and you'll see charts to where it has potentially, some of them will have examples to where you'll see the reversal patterns at the top, and at the bottom of it, you'll see continuation patterns. Use that, print it out, laminate it, keep it on your trading office desk, whatever. That way you can actually see it in relation to the market. So for those of y'all that are new to the market, and even if you are experienced in the market and you're not very good with reading every movement in the market, start back from the basics and get it right, right? So at this point, impulse, right? And then we have correction. So you have corrections and you have pullbacks. Pullbacks are going to look like this. Pullbacks are going to be fast, okay? Corrections are going to give you a little bit more price action. It's going to take a little bit longer. Not to say that it's going to take a long time, but that's the difference between a pullback and a correction, okay? So correction is going to give you a little bit more price action versus a pullback. It's going to kind of be quick, okay? So I did forget to mention that towards the top. You do have your pullbacks as well, okay? So this is going to be correction. Reason being is because it has a little bit more price action in it, right? So impulse, correction, impulse. Usually after you get a correction, you generally get an impulse. Remember how we were saying the types of patterns? We also have continuation patterns. Or if you also look at this correction is also going in a bullish flag state, right? Which is this. So this is also known as a continuation pattern. We're not going to focus on continuation patterns too much today. We're just kind of giving you guys a little insight on that. So again, impulse, correction, impulse. So this alone tells you that you're having a potential continuation coming. So it's telling you where the market direction potentially is going to go, just being able to read this structure in the market. As we break this down, you're also identifying structure. Okay. So after this impulse, we then have a pullback, not a lot of price action, right? So just a strong pull up, continuation down. This is what I would call a pullback. Impulse, right? So impulse, correction, another correction, right? Well, we know from these bearish flags, you typically will get another continuation, right? It's a continuation pattern. So you typically will get another impulse. So impulse, correction, impulse. We now reached a bottom, right? So we reached a bottom. The first pattern that I can see right here at the bottom is a double bottom. So it made a few double bottoms in here. So it has like an inner one right here. Also made another inner one right here. So twice at both of the lows, right? So each time it retests the low, it gave you an inner double bottom. So right here, it gave you an inner double bottom, letting you know it's potentially going to signal to go up, right? And then it came back down and give you another inner double bottom to kind of let you know it's going to potentially go up, right? Then it gave you a bigger picture double bottom, 3 double bottoms all in one. So it's telling you multiple times. Again, like I was saying, every reversal is going to show you some type of reversal pattern. You have to train your eyes to be able to see this in the market, right? So gave the double bottom pattern, push towards the upside. So generally, this, if you're a little bit more advanced, you can start breaking this down piece by piece. I'd like to just consider something like this a whole period of consolidation, right? So boom. So consolidation, correction, however you want to call it. So from a bigger point, you'll see that the market is correct, right? So impulse, correction, impulse. From, again, it's all about your perspective, how you see the market. So you happen to train your eyes, right? But from the perspective that we're looking at, we just see kind of that sideways market. So we're going with the consolidation. Cool. So we peak to break at the bottom of the consolidation, sweep lows, take this low as well, mitigate, right? Liquidity sweep, double bottom here. Cool. Reversal pattern towards the upside. All of these are more than likely going to be double tops or a head and shoulders pattern. You can see the double top cleared here. Again, it's not going to always be perfect. That's one thing I want y'all to know, that you do, please do not expect these patterns to be perfect all the time. They're not going to always be perfect. You'll have sometimes an impulse push up with just like this, and this is what's going to make that second right shoulder for the double bottom. You can get the ugliest double bottom, or sometimes you can get the prettiest double bottom. It's all up to, you know, how the market wants to print it, and then how your eyes are seeing everything, right? So again, you can get it multiple ways. You just have to try to find it. Here's an example to where you can see at the bottom, just at the bottom of this area here, you see a double bottom right here, right? Right here, you see an inverted head and shoulders, reversal pattern. Boom. So all of these areas are going to give you some type of reversal pattern. Every peak in the market is going to show you some type of reversal pattern. You just have to find it, right? And that, again, like I was saying towards the beginning, that sometimes causes for you to have to fluctuate through those different time frames. So be mindful that you're not always going to see it on the 4 hour. Right now we're on the 4 hour. You might have to go down to the 1 hour to see this a little bit clearer, or these areas here. I can see a head and shoulders right here at the peak of this area. Right? And so this is what you guys want to practice when you're going through and trying to understand market structure. You want to be able to do all of this. Now, this is kind of breaking it down more intricate, because we're trying to break down the highs and lows within a period of consolidation. So it kind of takes a little bit more skill for your eyes to see. But if you're outside of that consolidation, it gets a lot easier how we were looking here. So I don't want y'all to start trying to break down the inner waves, because you can break down all of this inner as well, which I'm going to show y'all how this works when we go over these Elliott waves. But when you're starting off, just Focus on the outside of the consolidation points and outside of the inner waves and get the bigger picture first. And then it'll be easier for you to see the smaller inner picture. Cool. So double bottom, impulse, right? Reach a peak, double top. Cool. You can argue that this could be a head and shoulders as well. The reason I say that is because this one impulsive candle, right? So that could be the left shoulder. This one impulsive candle could be the head. And then this one right can, like this one right side push up could be the right shoulder. You can argue that it could be head and shoulders, could be a double top. Don't confuse yourself. They're both are reverse patterns. They both mean the same thing in the same area. They both mean that it's gonna drop right here. So don't try to confuse yourself on, trying to study too long, or is it a, not wanting to trade it because is it a head and shoulders or is it a double top? They both mean reversal. That's what you were probably looking for at this top, is for the market to reverse. So you want a reversal pattern. It don't have to be a double top all the time. It doesn't have to be a head and shoulders all the time. It can be rising wedges. Again, Google forex reversal patterns. You'll see all of the different general patterns that you would see. Go off of those general patterns. There's only like 6 or 7 reversal patterns. There's not like 20. There's only a few, and I already gave y'all majority of you. So double top, double bottom, that's 2. Head and shoulders, inverted head and shoulders, that's like 4. Your rising wedges, falling wedges, that's like 6. So there's only like 1 or 2 more. So you're looking for these same patterns. So you have to train your eye to see them. So boom, double top, head and shoulders, whatever, right? Impulse, pull back. This gets a little bit choppy here. So in general, you just want to, we're going off the bigger picture, right? So in general, we're just going to go ahead and go with impulse. We're going to grab this whole wave. We're going to go with pullback, and then we're going to go with impulse, okay? At the bottom, you see the reversal pattern. I don't know if y'all can see that. I'll give y'all a few seconds to see if y'all can see it. See what y'all see. All right, cool. So if you can't see it fast, that's fine. Practice this a few times. Eventually, it's going to teach you how to see it a lot faster. But what we have here is a double bottom, okay? And I don't want y'all to think that we're just going to go with something very, very basic, because this is how you understand Elliott waves. If y'all are noticing right now, and we haven't got too intricate in these waves, but we're pinpointing out the key significant areas, which we will then be able to mark these up as waves. So we're going to go back through and mark these up as waves, and I'm going to show y'all how all of this works, okay, in relation to Elliott waves. But first, you need to understand how the market moves. And as you pinpoint these out, you'll then start to be able to pinpoint Elliott waves out on your own. So this is going to be real intricate. I want y'all to just kind of look at this as one big impulsive wave. Until you get advanced, then you can start to break these down. But this is going to be very hard, even for myself, because then you're going to have to go impulse, right? I'm just going to mark this up. So we're going to go for all the kind of the more significant areas with the kind of bigger retracements that they have. So what I'm looking at is, you'll see how some of them will go like this, impulse. I kind of have like a bigger cup to it right here, like a bigger cup to it, and then an impulse. And then some of them might just be like impulse like that and then impulse. So I'm skipping over the ones like that, and I'm going with the ones with the bigger cup to them. These are going to give you a little bit more significant wave, right? Versus these. So you see how this one has a bigger kind of a cup to it, versus see how this wave right here, this is like real small right here. See how that's kind of real small right here? So I didn't count that one. I kind of stuck to the ones with the bigger cups to them, like this one, and this one, and then this one. So I didn't go too intra on this one. So if that makes sense for y'all. So when you're looking at the waves, you kind of want to go with the more significant ones versus the kind of inner ones, unless it depends on your perspective that you're trying to go. So if you're intraday looking on like the 1 hour and below, then you might want to take in consideration some of these smaller waves. But if you're looking on the 4 hour and potentially above, you probably want to go with the more significant ones. Always remember that higher time frame is always going to be more key in any kind of analyzing in the market. Now, when it comes to the lower time frame, you're mainly dropping to the lower time frame to kind of hone in on that higher time frame to really grab the entry. So that's when you're mainly dropping to that lower time frame. Or if you're a scalper or intraday trader to scalping, then you probably already trade from a lower perspective. But as far as general rule of thumb, the higher time frame is always going to give you more significance. And then from there, once we get the bias from the higher time frame, we then break it down to the lower time frame to then grab that entry. That way we minimize potential drawdown and things like that. So altogether, one big wave. Again, it can get intricate. And at this point, you're having to figure out, okay, which wave is 1, 2, 3, 4, 5. So it can get a little tricky. And some examples are going to be a lot more easier. For example, like this area here at the top, we get a double top, very small one, right? And then we impulse, then we correct, right? Then we impulse, pull back. Not a lot of price action here. You see how there's way more price action here than here. So this is what you would call a pullback, right? And then we reach the bottom, right? So at the bottom, again, on this one, you'll probably have to break it on a lower time frame to see exactly what's going on here and what pattern you're seeing here. But if we look from a bigger perspective, we can see a bigger double bottom playing out right here, right? See that? It's going to be your low. Cool. So at that point, we then impulse back up. Okay, we reach the top. We get a smaller time frame, about a 1 hour time frame double top right here. Cool. And then we impulse down. On this one, again, inner wave right here. I'm not going to focus on that. Going to focus on kind of the significant wave. So impulse, retracement. So this would be pullback. Impulse. This is giving you a little bit more price action. So I would probably throw this one a little bit more in the corrective state. Impulse, pullback. Impulse, pullback, impulse. This one giving you a little bit of price action in here. You can argue that this could be pullback or impulse. Don't confuse yourself. They both are telling you that corrective structure or impulse. Corrective structure or pullback. They're both telling you that the market is potentially about to hit back down. So we'll just say pullback for this example, and then impulse down. We're not going to worry about the inner wave, so we'll go with the full impulse down here. Okay, and then we get a inner double bottom there, push up to get a double top here. Sorry. And then the drop. So back looking at this area, and we're about to wrap this up. I'll say probably when we get right here, and then we'll hop over to some other things. So from this area here, you'll see the peak, and then you start to form your structures on the way down. All of these are going to be waves, y'all. So all of these are going to be waves, and we're going to break them down as we go through everything. So now that we got to the bottom, pretty much another period of consolidation as a whole. Again, you'll start to see it getting a little bit harder to read in these consolidated periods. And then even in this case, we broke consolidation to kind of go through another period of consolidation. And then we broke out and started to trend again. And so at that point, we'll start to be able to read the waves a lot more clear. So if the market is consolidating, it's going to be harder to read the waves. If the market is trending, it's going to be easier to read the waves. Okay. So that is going to be your general of how you analyze and break down price action. Now you can start to break down these inner waves in every single movement, but you need to learn how to get the general perspective of how the market moves first before you start breaking those down. The main reversal pattern that I see a lot frequently these days and that's more accurate, are going to be double tops and double bottoms. Those are my favorites to go to. I don't like head and shoulders that much. The general rule of thumb, I mainly see a lot of double tops and double bottoms more than anything. So as you can see, as we were going through this, we're mainly identifying double tops and double bottoms as we go through this. Not a lot of head and shoulders we were able to identify, even though you still see them, but mainly we're seeing double tops and double bottoms. So take this illustration for what it is, because this is how the market actually moves. Okay, so next thing we'll dive into is going to be Fibonacci. So Fibonacci is needed in order to know how to do Elliott Wave. So all of these waves happen at a certain Fibonacci point. So I'm not going to dive too deep into Fibonacci on this session, but just understand that Fibonacci is required in order to understand Elliott waves. And then as we go through the waves, I'm going to show y'all how some of them will go to certain points, right? So the 61.8 is going to be one of the main points, as well as the 50, and then our 618 area. So it's going to be some of the main points that we are using as we break down the Elliott Wave. Okay. So let's see. Let's see where I'm going to start with y'all with this one. Okay. So general rule of thumb, you'll have 5 waves, right? So we already went over this. You'll have 5 waves. On the inner waves of 2 and 4, you're going to have either a 1, 2, 3, 4, 5 on the inner wave, okay? Or you're going to have an ABC, okay? So these are the 2 patterns that happen on, and it's not even just 2 and 4. These are all of the waves. But I'm just giving y'all an illustration of how the waves are broken down into waves. So you're going to break the wave down into another wave. So it's all waves. So literally, let's say right here, and you generally don't get the same wave back to back. So for example, if we are on wave 1, wave 1 might happen in an ABC form, right? Boom, and then you peak to the bottom of wave 1. Wave 2 is going to more than likely happen in a 1, 2, 3, 4, 5 form, right? Then you'll have wave 3 more than likely happening in another ABC form, right? And then potentially wave 4 is more than likely going to happen in another 1, 2, 3, 4, 5 form. So it doesn't have to happen like this. It can do ABC and then another ABC and then drop down to, it can do whatever order it wants. Just generally, I usually see it happen like this, whichever way it starts, so it kind of rotates, okay? And then you can potentially see another ABC there. So in every single wave, it breaks down into more waves, which I'm going to show y'all as we go through this, right? So for example, the easiest ways to start off with trying to find where to start and look for Elliott waves is starting with the top or bottom. So for example, we have a double top here that we've already marked, so we already know that this is the top, right? So as we were breaking down these waves, we can start with this being the top. So this would generally be 1, right? We've already marked this up. So again, this is why I say doing this helps you a lot, because it'll start to help you identify the market, how the market moves, and then it'll be easier for you to mark these waves. So now we have wave 1, we have wave 2, which we know is corrective. We have, and so I would probably go for this area, and I'm gonna show y'all why we didn't choose this pullback right here instead as wave 3 instead of this. Okay, so then we have wave 4, and then we have wave 5, right? So again, this is why we started off this way, because it helps you identify how the waves are going to move. So you already can see your peaks, you already know, right? So the reason we didn't make this 3 and then do it like this 4, 5 is because remember, 3 is usually not the shortest wave, right? And if it is showing as potentially the shortest wave, your wave count is probably off, right? So if we look at it right now, 3 would end up being 213 pips. Wave 1 would end up being almost 300 pips, and wave 5 would be around 220 pips. So it's cutting wave 3 short within that range. So I wouldn't want to try to maybe choose that one. I would probably want to go for wave 3 is usually probably be your longest wave. So I would want to go for something like this, right? Instead of that. So that's how we choose in that example. So, and that's correlating into how I was just saying that, you know, sometimes your wave count might be off. So this is how you sometimes break it down on, you know, where you might be off. Or you can use the indicator that I'm also going to be showing y'all, which can help you double check everything. So I want to show y'all this first naturally without any indicators, because we don't need indicators to trade. So I want to show y'all this naturally, and then you can use these indicators to help you, you know. So that's how you use indicators. You don't want to start off trying to trade off of the indicator or learn how to read the market based off the indicator. No, you learn how to read the market based off of pure price action. And then you use these tools to kind of aid you in the market, right? So you are the robot, you are the indicator first, right? You are the AI, you are the EA, right? And then all of these other things, you put them on top of you to make you better. So that's just how I like to see things in the market. But if anybody asks, I'm the indicator, right? And then at that point, if I do want to use anything extra, it's just icing on the cake, right? But I can do all of this on my own without any indicators. So This is pure price action. We're breaking everything down from raw price. We haven't used any type of indicators, anything. This is pure price action basic, right? But it's how you implement it into the market and your understanding of it, and how you train your eyes to see everything is what's going to teach you how to understand every single movement of the market. So what I'm teaching you right now, y'all can use this even in your own strategies right now. Because what I'm doing is showing you how the market moves and then the wave structure that it moves. If you trade ICT, if you trade smart money concept, no matter what your style is, you can implement that on top of this. That's just going to help you at wave 4. Then you're going to use certain things as far as like your whatever strategy that you use. You're going to then use certain things around this area to give you that indication of where wave 4 might end, where your entry might be, where your stop loss might be. You're going to use all of those other things on top of this to help you get the full analysis, right? But in general rule of thumb, you want to kind of get a picture of how the market is moving, where the market could go, what phase in the market that you're in, what wave you're in. That way you can know what to potentially expect. So that's one reason I love Elliott Waves, is because it helps you predict the market. So you can predict the market. You can definitely predict the market. If you know what you're doing, if you have the education, you've had the time in the market. So not just the education, but time in market is almost just as important as education, because you can be trading for a year or two, but if you haven't had the time in the market, you haven't seen how the market fully moves. You have to experience and see how the market moves. And that comes from being on these charts every day. And not even just every day, but being on the charts for a significant period of time to see certain things. And for example, to see an election, right? See how the market reacts in an election. See how you react in an election, right? Your mental, your emotions, different things like this. Brexit, all kinds of stuff. Like I traded through Brexit, all, you know what I'm saying? Like all of these things only come with being in the market at a certain period of time. If you just started a year ago, you don't even probably know what Brexit is. So different things like that, you know what I'm saying? Like it comes with being in the market for a certain period of time. You're able to see how the market moves. After you see these movements, these patterns so much from, again, time in the market, your eyes just naturally start to see them, right? So it becomes just natural for you. So boom, 5 waves right there, right? All of these waves are going to pull back at a extension point, right? So, or a Fibonacci point. So if we drop Fibonacci, you'll see that a majority of your corrective points for 2 and 4 are going to more than likely be between the 38.2 and the 61.8. So when you have all the wave 2s and wave 4s are going to pull back to a 38.2 or 61.8 retracement. So anytime that, if there's no price action right here, so if there was no price action right here, then what we would be looking at in general is once it reached this bottom, for those of y'all that know, this is a fair value gap. But once you reach this bottom, again, you can use other things in your strategies to even let you know where the bottom can be, right? So how would I know where wave 1 would end? We use other things on top of that to help us identify all of these other things, right? But right now I'm just showing y'all waves, right? So boom, we would generally just be looking for 2 to establish itself between 38.2 and the 61.8. Also, remember we had a double top here. General rule of thumb is when you have a double top, you generally retest where that double top neckline was, right? And then you generally would look for a continuation down. So if you click play, we'll see that that's pretty much what happened just off of even price action structure. So break and retest of that double top, which then also, if we look a little bit more intro, we then see that that's also a wave structure that printed, which is wave 2. And then now we extend and then go further into price action. So that is how that works, y'all. Turn this off. As far as waves. So now let me break down the inner waves within this wave. So I was saying we have the general 1, 2, 3, 4, 5, right? So I'm gonna clean this up as much as I can without taking too much off so y'all can still see what's going on. And again, this is going to get intricate, so I hope I'm not confusing y'all. Rewatch this over and over until you understand it, until you master it. redo this again, go through charting the waves, impulse, correction, pullback, double top, double bottom, head and shoulders, rising wedge, falling wedge, continuation pattern, reversal pattern. What is it? Train your eye to see this, and then you'll be able to flow with a lot more of this stuff naturally, right? So we already established that this was a pullback, right? So general rule of thumb, your ABC patterns generally happen between your 50 and your 61.8. So in this case, the 38.2 is not in the scenario. We're only going to be looking for the range of the 50 and the 61.8 when we're in an ABC scenario, right? So you can tell how it's an ABC scenario on how the movement of price is. So when you have a 1, 2, 3, 4, 5, you're gonna have something like this. See how it's so many waves in here? You can't even tell. It's clearly not an ABC because look how many ABC is just gonna be a boom, 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 right? So this is literally a boom, 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 like a whole bunch of booms. So you have to break down now which one. This is going to be a 1 through 5, but you have to break down which one is 1, which one is 2, which one is 3, 4, 5, based off of significance, right? So in this case, we're able to see it a lot more clear. We can clearly see a boom, and a boom, right? So we can clearly see the ABC pattern. Now, if we drop the Fibonacci from wave 2 to this low right here, we'll see that it retraced up into the 50 and the 61.8. So we went from this high to this low, and you'll see that that came into that 61.8 and 50 range and then dropped back down. So at that point, we're able to see the ABC. Now, also, how do you know where you can, Elliott Waves is so beautiful, y'all, because it really points out every single movement. So this ABC pattern will also show you when it would end and where C would happen, right? So, and then to find C, I'm going to take this Fibonacci off. Again, you have to understand Fibonacci in order to even know how Elliott Waves works, because all of these points will show you where the extension will go. So in order to find C, you would take the measurement from the first wave here to the top. So from A to B, and then you would drop it. So I'm sorry, not A to B, from the original A. So all the way down from the top and the high of A to the start wave A. So this is the whole wave A. So this is B, and then this is wave C. So wave A, you would drop the Fibonacci from the top to the low. I have my Fibonacci reversed. So you'll see the 272 at the top, the 618 at the bottom. I'm sorry, the top. And then you'll see the 272 at the top and the 618 at the bottom. So no matter what, even if I flip it like this, it's still gonna show me the same thing. So that's just how I have my Fibonacci set up on the extension points. Now it's going to show you something completely different on the 78.2. I'm sorry, the 78.6 through the 38.2. But as far as just the Fibonacci extension points, which are going to be the 272, the 618, the 1272, 1618, same thing. It's just flipped. So you can use your Fibonacci expansion tool to also give you those. I don't use the Fibonacci expansion tool. I added them to the normal Fibonacci retracement tool. That way I can just see them on my normal fib and I don't have to add the expansion. So if we drop it back from that high to that low, you're going to be looking at the 1618 as your reversal point. Pretty much a lot of your Fibonacci points, even the 1, 2, 3, 4, 5, your wave 5 is more than likely going to come at a 618, right? Your ABC, your C is more than likely going to come at a 618. So anytime that it starts to get near this 618, we are now on high alert for an area of interest, right? So a potential reversal. Again, we don't just trade off of one confirmation. We add multiple confluences to get our entry, right? So at that point, you know that now there's going to be a reaction around this 1618. So then what do? We add all of the other things that we know as traders, like, I'm not going to mention everything in this video, but just other things that we know as traders all into one perspective to give us that vision. So whatever that you're using, things that identify exhaustion, things that identify potential reversals. Remember, reversal patterns just themselves are going to identify a potential turnaround in the market. A lot of different things, supply and demand. You can use a lot of different things. So whatever your strategy calls for, that's when you're going to start putting that on the chart. Once we get around the 1618, and then you look to see what do you see in that area of that 1618, where is all of your confirmations saying that the market is going to reverse, and then you go with that, right? You put all of those together, and then you say, okay, this is that area then. So this is just one tool out of the multiple things that you're going to be using, and then you're going to sum them all up and then get your entry from there. But more than likely, it's going to show somewhere in that range, right? But you're just going to narrow it down. So that's when you break down the higher time frame to the lower time frame, and then get your entries, right? So again, this can be real intricate for a lot of y'all. Just practice, practice, practice over time, and we'll break it down for y'all. Y'all have the education available to y'all as far as to start from beginning to ending, as far as learning how to trade. So that's already available for y'all. This is just more education for y'all to give y'all another way to break down price action and to add this method potentially on top of the things that you're already using to make things a lot more easier and smoother for y'all when it comes to reading price, right? So this is an example to where you would have an ABC within an inner wave, right? And then you can, if you don't see a clear ABC, then it's more than likely forming a 1, 2, 3, 4, 5 within that inner wave. This here between just this wave down on B to C. So this wave C here, it has another inner ABC right here as well. So you'll see wave inside of wave inside of wave. So it's going to happen all day. So it's up to you. Again, train your eyes to be able to see everything, and then you'll kind of eventually learn how everything works. So again, you start when it comes to finding these waves, you want to start from a clear top, clear peak. So here's a high, here's a high, here's a bottom. This is a period of consolidation. Remember how I said it's going to be harder to try to find this stuff in consolidation. So you really don't want to try to start it in a consolidated period. You want to try to grab it at the top of a wave of the bottom. So that's why we started here. So maybe this bottom or this top and this bottom, which is all just one big period of consolidation. Maybe we don't want to start looking for it in that area. Maybe we want to wait until it starts to break out of that area. So let's say we start from here, right? So we have a 1, 2, 3, 4, 5. Again, we already plotted this up because we already broke down the wave movements of price action, right? And then once we reach 5, we already know that now we're going to be looking for a reversal pattern, right? So what did we get? We already broke it down. So again, this is why we started off with that real basic. So if y'all felt like it was real basic from the beginning, this is how now it plays into price action. When you're able to understand and read it like this, then it just makes it so much easier for you. You already did the work. So now you already see the double bottom already happening. You're already expecting the reversal pattern, right? At the end of wave 5, this extra move is fine. Again, just a sweep of the low, take majority of them out, traders out if you can, and then you get the movement back towards the upside at the end of wave 5. So again, every reversal point, at the end of every wave, you're going to be looking for a reversal pattern. As we can see, the market printed that reversal pattern and then started to take back towards the upside. And then within here, you'll have a more set of waves as well. So if we break this down on the lower time frame, this is actually a 1, 2, 3, 4, 5. So you'll have that 1, 2, 3, 4, 5. So this is breaking it down from an inner perspective, and you see those small retracements of what's going to make that 1, 2, 3, 4, and 5. So within every wave, you're going to have even more waves. And if you're able to break it down and understand what wave you're in, well, then you know potentially what to expect and where the market will go. So it gives you that much more of an advantage on trading in the market. So that's a few examples of how you would look at Elliott waves. Again, this is not just something simple. So if it's confusing for y'all, I understand. You want to go over something like this multiple times. Train your eye to first see the movement of the market. Then you need to understand how Fibonacci works, because this is what's going to show you your expansion points. You need to understand where to place Fibonacci, right? And so you're placing Fibonacci at highs and at lows. When you learn, if you don't know how to peek or identify highs and lows, this, again, when we started, this is what's going to help you understand how to read highs and lows of the market, see which areas are more significant than others. Going through this exactly how we went through this is what's going to help y'all, right? So now that we've broken everything down through pure price action, we can use other things and indicators to help us potentially see where some of these Elliott Wave points could happen, and to just give us also confirmation. So I use the Lux Algo Elliott Wave tool. So you guys can go to click, and so this is trading view. Click on indicators, go to the top, Lux algo. And then if you scroll down, you'll see Elliott Wave somewhere on here. Here it goes right here. So Elliott Wave, Lux Algo. This is the one that I use, right? I don't think that this is paid, if I'm not mistaken. I don't think it is. I haven't paid for the actual indicator itself. I am a paid member for TradingView platform. So it could be a TradingView you need to subscribe thing, but I think this is available to everyone if I'm not mistaken. So this is the indicator here. So you would click that, put it on your chart. Here it goes right here. Here are the settings. I don't think that I've changed anything for the settings on this bad boy. So there you guys go. Once you add that onto your chart, you'll see how now it's placed it onto my chart. Okay, so you'll see it starts to break down a lot of these inner waves, kind of can give you a little bit insight on what wave might be which. So remember how we were saying we couldn't really tell what wave might be 1, 2, 3, 4, 5. Well, now if you put this indicator on here, it shows you the more significant waves. So here's the significant 1 to 2, extension up, 3, 4. Remember, 3 is probably not going to be the shortest. So you want to make sure that 3 is probably a little lengthy. And then 5 being the shortest, so that makes 3 okay. So all of the rules played into play here. So this indicator then was able to break down these harder areas for you, right? So remember how we already broke this down as well. So it already showing you here, boom, 3, 4, 5, right? So it already showed you 4 and then 5 down here. So it's helping you identify these and making the job just that much more easier for you guys. And then showing you, it also highlights the ABC patterns as well. So that's something for y'all. Let me see, go left, go right. So this is one of the ones that we marked up here as well on a 1, 2, 3, 4, 5. So we started from the top point here. So you can see it ended up starting 1 from this area here and kind of trickled its way down. What we did get was 4 on the same point. So arguably, again, sometimes your wave count might be off. I'm not going to necessarily say that the indicator is more right than me. I could still be right in this example. If I were to take this trade, it would have still turned out right. When you are taking the Elliott Wave trades and you're looking for the retracement trades, so like 2s and 4 wave 2 and 4, because remember those are the corrective or retracement waves. General rule of thumb is, again, like I was saying, you're going to expect that 50 and that 61.8 at max. You would get the 78.6. So, and the 78.6 is generally used as your stop loss level. So you want to put that stop loss right after the 78.6. So you'll see something like an invalidation right there. Okay, and then you would be able to trade this down. So at max, the most I'm personally, again, this whole tutorial that I'm giving y'all is me. It's how I use all of this, how I've been using it over the last 2 years, 2+ years. Okay, so this is how I trade it. There's tons of different ways that other people trade and how they view it. Again, we're all human. We all do things differently. Our brains work differently. We're going to see the market differently. We might have similarities, but we might not all see the same thing, right? So this is how I see it, how I use it, and how it's been effective for me. Okay, so at max, the most I want to see is a 78.6 retracement on those corrective structures, and it needs to, and I give it a little wiggle room because again, we could, give that reversal pattern with the wick above just for it to close right below. So on the lower time frame, you could see a lot of price action above here, right? But on the higher time frame, it's just a wick above and a closure below that 78.6, right? So for this example, if we take that Fibonacci and we drop it from this high to this low, looking for that retracement of 2, you'll see that it ended up pushing up to that 78.6. But if we gave it that little wiggle room for invalidation, then we would have been good to go to hold that trade and to ride that whole way down. Now, mind you, we would have been selling around the 50 or the 61.8 anyway. So we would have been looking for a stop loss of around 30 pips, and then we would have took this for the extension. Remember, it's more than likely going to go to the 618, exactly where it went and retraced up. So our trade opportunity for this would have gave you a 5-to-1 trade opportunity regardless. Even if we would have took it from the 50, you still would have got a 3-to-1 trade opportunity. So still would have been a good opportunity for y'all to trade just in general, right? So this is how you're using this. This is how you're getting your targets. Again, We just went over how, just quickly, that 618 was your general rule of thumb of where this extension should land. So knowing that that's where that should land, that's also telling you your potential target point, right? And I just gave you a way to potentially identify your stop losses. So now you're able to identify Elliott waves. You're now able to identify the potential targets for Elliott waves alongside using your other things that you already naturally use to identify targets in the market. And you now have your way to look for stop losses as well. And you also know where to now look for the entries for these Elliott waves as well. So like I just said, you're going to have your correction wave 2s and 4s more than likely going to retrace to a 50 or a 61.8 retracement at max at 78.6. In a perfect world, you can get them at a 38.2. It's going to give you your pullback form, and you're going to have a very impulsive market. So that's where you're going to see it. It doesn't give a lot of movement. It's just going to, give a quick pullback and move down. So those you're going to usually get your 1, 2, 3, 4, 5s. Very rarely you'll get an ABC in those. You'll have to trade down to a little time frame. You will see it a lot clearer. But I don't want y'all to go off of the perspective that they could never happen, right? They can both equally happen. You can get ABCs or you can get 1 through 3, 4, 5s within it, and it can retrace between the 38.2 and the 78.6. That's your full range, okay? So that's your full range, and then you have generally what would happen. So that would give you a breakdown on, let's say you are looking for it to reverse at the 50 or the 61.8, but you're getting nervous, right? It's still pushing up. Well, you also know that it can also happen at the 78.62. So now you have just a little bit more peace of mind. You know that that's your last level. Like it can't go no higher than that, or it's going to go back up. And if you just go off a general price action, well, yeah, if it goes back up, it's going to also, we're in a structure of making lower highs and lower lows. So if it goes any deeper than that 78.6, we're going to now test into this high. We could then potentially make a new high, and then we'll start to change the trend and making new higher highs and higher lows. As we were breaking down these waves, we're also identifying lower highs, lower lows. So the market goes to a lower low, lower high, lower low, lower high, lower low, right? So if this market is to break above that 78.6, it would then invalidate the current structure that we're looking at, and it would change from a bullish structure and then bearish market structure into a bullish market structure, right? So at that point we would take that high. Every higher high comes with those are set. So higher high and a higher low, they're set. A lower high and a lower low, they're set. You don't get one, you get both. So these come in pairs. So if you get a higher high, it will come with the higher low, right? So it will come with the higher low. That's going to happen. So if you have a lower high, it will come with a lower low, right? So they are a set. It will happen, right? So understanding that they are a set, the moment that we make this new high, we have now made a higher high, right? You know what comes with it. It's a set. So now you're expecting a higher low. This move right here is not the higher low. The higher low has a movement off of it, right? So if you're selling this and you see it make a higher high, you know that a higher low is going to come. And you know that more upside is going to come. So you don't want to be holding this. You don't want to be continuously selling this. You don't even want to have a bearish bias continuously at that moment, because now you know that the trend is potentially going to be shifting and changing. And let's say that the market was coming from an impulsive state from this area. So if it's going to continue up like this, then we could have a wave like ABC like that. It could be coming from somewhere completely different. So again, you have to train your eye to see everything. You're never just looking at one area in the market. You're always taking a kind of a zoomed out perspective back. The best way to look at a chart to me is like this. This is the best, probably zoomed out way to get your bias of a chart. You can't get the full bias of a chart by just being completely zoomed in. You can't see all price. You can't see full price action. You can't see if it's in a full downtrend coming from this area. You don't know if this came from up or down. You can't see everything. So you have to, I see a lot of traders, and I feel like this is one of the biggest mistakes, that they're too zoomed in. You have to zoom out to see what's going on, to see the structure, to see the waves. You can even see bigger reversal points. You can see a bigger double top right here. So this would have told you that price action is more than likely going to lead way further down. And you can, a lot of these reversal patterns, I didn't go over this because this is just further education. We're just mainly focusing on double top, double bottoms, but all of these patterns also come with measurements, which also let you know where they can go, which also then in return gives you potential target points, right? So if this is a double top, you know that it's more than likely going to give you, if you measure this and clone this measurement, it's more than likely going to give you the same equal measurement. Now, what I like to teach everybody is that I normally go off of 75%. So I don't go for the full measurements of everything. I like to go off of only 75%. So, and I don't take it, I don't like, so see how this, this measurement was 288 pips. You won't see me pull out a calculator and divide 288 by 4. No, I'll roughly look at it, and then I'll grab about 75% how I just do that line, and then I'm going to look at price action. I'm going to look at other things in the market, and I'm going to say what all areas are showing me some type of reaction around this 75% mark. Am I seeing supply and demand around that area? Am I seeing psychological levels? Am I seeing a Fibonacci point? Am I seeing whatever it is that you use around the 75% range? I'm going to look for that as my potential target range. I'm not just going to take the measurement of 75. I'm going to look for that, and I'm going to target one of those areas. There could be something right here, a supply or demand, wherever, right here, right? A demand, and I might want to take profit right before I get to that demand, right? And so if you look to the right, you'll see that going by that 75% would have got you out of that trade right before we got to this, all this extra consolidation. It took literally from the 17th all the way, almost 2 weeks, right, before it finished to peak all the way down to hit your final TP. So if you'd have went for 75%, you would have saved yourself 2 weeks of waiting, you know. So just rule of thumb, something of how I look at it. But again, zooming out allows you to see the market from a way different perspective. So try not to be too zoomed in. Break it down from a zoomed out perspective. Again, you don't have to be too zoomed out to where you can't see the candlesticks. You know, you can still see all the candlesticks right now. You can see what type of pattern each candlestick is forming. But as of right now, that's not really important. You're looking at that when you're breaking it down a little bit more, and not necessarily to change the time frame, but when you're looking at the actual, the peaks, you know, the top and the bottom, you know, you're looking at the type of pattern. If you're looking for a continuation, you're looking to see if you're maybe getting a bearish engulfing right here to signal further downside. That way, letting you know the next candlestick might give you even more continuation down. You're looking at spinning tops at the peak. You're looking at inverted or inverted hammers, things like this. All of these are also reversal candlesticks or continuation candlesticks. So you can break this down even more to give you a little bit more insight of what the market could be doing. But right now, we're just focusing on waves and reversal patterns to help us identify things. But again, you can use so much to help you as far as being a little bit more of a consistent and fluent trader just in general. So y'all, that's pretty much how you look at a lot of this. And again, you can throw that indicator on there to help you see a lot of these things. If I scratch the chart right now, it'll show you just the indicator. Okay, so I just took everything, all of the work we just did off, and it'll show you literally the indicator. If I put it back on, which I don't think it'll actually let me put it back on. There it goes. So we put it back on, so all of that, we take it all off, boom. There's all, this is just that pure indicator itself. So it does highlight also potential target points for wave 5. So at the end of wave 5, you'll see that it will draw these, see how it has these different boxes here? These are all based off of Fibonacci. So this final area here is generally going to be your 618 range. So if we drop Fib from wave 4 all the way to that last wave, so the full wave 5, we measure it, you'll see that 618. Remember, that's what we target generally after wave 5. You'll see that it aligns right here. So again, we don't need the indicator to help us find these targets, to find anything, right? But it does take some of the work out for us and help us, you know, just be a little bit more, move a lot faster, be a lot quicker at what we do. So again, never try to train yourself to, you know, be trained by the indicator, but yet make yourself the indicator and use these types of tools on top of the things that you already know to help you, become a lot more profitable trader. So that's pretty much all I wanted to wrap up for y'all, man. Give y'all a little Elliott Wave course here. This is going to be that 2.0 for y'all. Show y'all how to fully break down price action piece by piece. Understand all of the movements in the market. Understand how to find targets, stop losses. Understand the trend itself, if it's correcting, if it's continuing, if it's looking for a reversal. What phase of the market are you in? What wave are you in? Are you in another wave inside of a wave? Are you in a corrective wave inside of a wave? I mean, we completely broke down every single thing today. So if this feels confusing for y'all, it's fine. That's normal. I've been doing Elliott Wave for almost about 2.5 years to get to this point to where I feel comfortable enough to even drop this type of educational material for y'all. So it takes time, right? So time and market, like I was saying, it takes time. You have to be able to practice this stuff over and over and over. See how it works. See what works, from your own personal trial and error. How many times did you try, seeing if a B point would come at this area, and it failed, versus how many times did you try a B point at this area and it worked? So just that, having that time in the market to be able to do the trial and error, to be able to see if whatever you marked up was right? If it turns out to be correct, which is going to give you that confidence boost to be able to do these a lot more often, and a lot more frequently. And just, you need that confidence as you're trading, the confidence of getting the trade right. Because when you get it right, it's like, doing a math problem. When you get it right, you feel more confident to be able to do the next math problem. And you'll be able to go up to algebra, and then you go higher and higher and higher. So that confidence builds as a trader, and it helps you become more just fluent and consistent. You got to be confident in everything you trade. When you enter that trade, you want to be confident. You don't want to be nervous when you're entering the trade. If you're nervous when you're entering the trade, you probably shouldn't be entering the trade. And you're probably nervous because you don't have enough confluences, right? If you don't have enough confluences, then potentially you might want to look at something else that does have more confluences. If the trade doesn't have a lot of confluences, that doesn't mean it's going to be incorrect. No, it could still go 100% perfect of how you were planning it for it to go. It's just, that confident boost a lot of times comes from confluence, comes from having multiple confirmations on your trade, having 3 to 5 confirmations. That strategy that you use is what's going to, give you that confidence. You're seeing all of these things line up in this one area. You're like, oh yeah, this is definitely it. So build that confidence, man. Make sure you are trading, having that time in the market, practice this stuff. Again, starting from exactly how we started, breaking down every single wave. And then at that point, you'll start to be able to read the market, understanding what type of market you're in, understanding your tops, bottoms, consolidated periods, the different types of patterns. Again, you can Google forex reversal patterns, and you'll see the different types of patterns. You can also Google forex candlesticks, and you'll see the different types of candlesticks. You'll see which candlesticks indicate a reversal and such and such. So just some few nuggets for y'all, man. Appreciate all of y'all for tuning in to today's educational. Hope y'all learned a lot today, man. Other than that, man, y'all have a great rest of y'all's day. Happy trading as always. And we will see you guys on the next drop. Peace.